In this example, we'll be doing practice exercise 13.5a that can be found in your textbook on page 608. We are going to be journalizing the entries that are relating to Treasury stock. It tells us that on January 31st, Wilderness Resorts, Inc. reacquired 22,500 shares of its own common stock at $31 per share. On April 20th, Wilderness Resorts sold 12,800 of the reacquired shares at $40 per share, and on October 4th, they sold the remaining shares at $28 per share. Treasury stock is a company's own stock that it is buying back. So since we are taking away shareholders, it actually is a contra equity account. It's reducing our overall equity in the business. So on January 31st, we are reacquiring our shares. When we reacquire the shares, we just record it at what we as the company reacquired them for. And we debit our treasury stock for how many shares we bought, which again was the 22,500, and we multiply it by how much it cost us to reacquire those shares. So in this case, to reacquire 22,500 shares of our stock at $31 per share, it cost the company $697,500. Again, treasury stock is a contra equity account. It's reducing or conflicting with our equity. Therefore, it has a debit balance. You would see treasury stock on our balance sheet as a reduction to stockholder equity. And we paid for it, so we credit cash for the same $697,500. We can resell our shares of treasury stock, and the company does that on April 20th. It tells us that on April 20th, we are going to sell 12,800 of those shares at $40 per share. So we are selling it for cash. We are selling 12,800 of the shares, and we multiply it by the price that we are selling it for. And on April 20th, we are selling it for $40 per share. So we are receiving $512,000. What we are selling is treasury stock. So we need to reduce our treasury stock account. But remember, our treasury stock only went on at $31 per share. So we have to take it off at $31 per share. So we take the 12,800 shares that we're selling and multiply it by the price that we had purchased them for initially on January 31st, which was $31. So our treasury stock is being removed at $396,800. When we're looking at this, the cash that we received, the $512,000, is greater than what we had paid for those 12,800 shares. Because the cash that we received is greater than the cash we had paid, we are going to credit paid in capital from the sale of treasury stock for the difference between the $512,000 that we received and the $396,800 that we had paid to purchase those shares. So in fact, we have a gain of $115,200. However, we don't record it as a gain. Any gains or losses on the sale of treasury stock all go to the paid-in capital account from the sale of treasury stock. The paid-in capital from the sale of treasury stock account can be a contra equity account or an adjunct equity account. In this case, it's an adjunct equity because it is adding to the equity because we sold the shares for more than what we purchased them for. And the last piece they tell us is that on October 4th, we are going to sell the remaining shares at $28 per share. So again, we're selling them for cash. We initially had purchased 22,500 shares. We had already sold 12,800 of those shares. So we're selling these remaining shares at $28 a piece. So in total, we are getting $271,600. We're selling it for $28 per share, but we know that we paid $31. So we know that we're going to have a loss. So we are going to debit our paid-in capital from the sale of Treasury stock account. In this example, our paid-in capital from the sale of Treasury stock will be a contra equity account because we lost money and it will reduce our equity. And again, what we're selling is our Treasury stock. Again, we initially had 22,800 shares. We sold 12,800, and those were on our books at $31 per share. So, again, comparing the cash that we received of $271,600 to the cash we had paid to buy the Treasury stock, our cash is less, which means we've lost money. So we take the difference between the cost we had and what we're receiving, calculate the amount of our contra equity account of paid-in capital from the sale of Treasury stock. On October 4th, we're actually losing $38,400.